It turns out that I dance even when I'm talking regularly, so that was just a preview of how I normally talk. A big issue in general is that a lot of state insurance law and regulation is not specifically designed for AI. AI is, of course, new. And what that means is there's a lot of uncertainty in how law and regulation apply in a lot of different AI domains, which of course creates some dueling risks. On the one hand, there's the risk of under-regulation. There's the risk that we're going to have social harms associated with AI, and we're not going to actually mitigate them. But there's also the countervailing risk that we're going to have over-regulation, and we're going to end up actually deterring the use of socially beneficial AI. And so what I'm going to talk about today are 3 specific studies or areas that I've worked in that I think exemplify this and show how it's really important to have some more specificity and precision in the law and to inform law and regulation with economics, which is really, again, one of my core goals. I'll talk about product design, rating, and claims. And what's nice is each one of these actually has been brought up today. So hopefully this will be a nice closing session. It will remind you of some things. So I want to start off with parametric insurance. We've already heard a discussion of this. A parametric insurance policy is an insurance policy that pays out not based on your individual risk or loss, but instead based upon some objective metric that is determined by a third party. And it turns out that these have a lot of really important benefits in the context of claim. They pay out much more quickly. They're actually a lot easier to model because you know how much you might have to pay out in a tail end event. And there's no moral hazard or adverse selection because actually it doesn't depend on what you do, how much you pay out. So there are a lot of really nice benefits, and in particular, and we heard, again, I think reference to this, I can't remember when, I think just in our last panel from Adam, right? I think you were talking about parametric insurance, if I remember, and you said, and I agree, look, I really think that AI has the potential to improve parametric insurance by getting much more specific measurements and ability to link those measurements to personalized loss. But here's the regulatory problem, and it's a doozy. Under state insurance regulation, an insurance product must be a product that does not violate the indemnity principle. The indemnity principle is the principle that you cannot be made better off as a result of a loss. This is very related, for those of you who are familiar with insurance law, to the insurable interest requirement. And the problem is that parametric insurance policies inevitably create some risk that you're going to experience a windfall. Why? Because there might be terrible winds near your house, and it just might happen by chance that your house is fine. And so you get a payout, and you're made better off than you would have been had you not had the parametric policy. This results in a very difficult regulatory classification problem. Are parametric contracts insurance policies, or are they swaps under federal law? And this is really problematic for a number of reasons. First, it's actually incredibly difficult to sell parametric insurance because you don't even know the appropriate regulatory classification. Most states don't even have laws on these. The laws they have are incredibly underspecified. And by the way, if they are swaps, it turns out those are very difficult to access. So that's the problem. And it's a problem that's getting worse because of the fact that AI and analytics are making this actually a potentially really important part of the toolkit for solving climate problems, but risk and regulation are getting in the way. So I want to talk about a few solutions that I'm working on with a co-author, Jerry Skees, who some of you may know, who's quite prominent in designing these contracts. So the first solution that we're trying to work through is designing a parametric insurance policy where the parametric trigger is based not on an actual weather event, but a forecast of a weather event. In other words, the parametric trigger is, there is a hurricane heading to Florida. It is going to hit possibly in 4 days. It might destroy Miami. Or maybe even longer term forecasts like El Nino. It's going to be a really bad hurricane season. Now, why is this a potential contractual structure that can solve the regulatory problem? The answer we propose is because when there's a bad forecast, you will need to spend funds irrespective of what happens. It is appropriate to spend funds on hardening your structures, on getting people out of harm's way, whatever happens to the hurricane. And so you actually solve, with some additional complexities that I can get into, the problem of potential windfalls if you structure a parametric insurance policy in this way, because there are no windfalls, because once the forecast exists, if it's good enough, with AI, you have an automatic loss. So that's one example of the type of solutions you can come up with. A second solution we're coming up with or developing is what we call a restricted use parametric insurance contract. A restricted use parametric insurance contract is an insurance contract that requires you to use any proceeds from parametric policy in one of two ways. Either to offset any losses you have, or, if you're lucky and you have a windfall, to invest any excess above and beyond your loss on risk mitigation related to the underlying metric. So, if there's a hurricane and your house is partially destroyed but not entirely destroyed, and you get a parametric payout of $100,000, use $50,000 to repair your house, you have a $50,000 windfall, but you can't just use that on buying popsicles or ice cream or a nice new car, or whatever else you might buy in Miami. You actually have to use that or you forfeit the money on risk mitigation for future risks associated with that peril. And what we argue in the paper is that that is consistent with the way that law and regulation treats insurance policies, and we come up with examples. Our best example is law and ordinance coverage in the homeowner's policy. Some of you may be familiar with this, but your homeowner's policy will give you an extra 10 or 15%, depending on the policy, beyond your coverage limits to build up to new codes. And technically, that makes your home more valuable than it was, because now you have a home that's up to code and people are willing to pay more. No one has ever, in the history of insurance law or regulation, suggested that that violates the insurable interest requirement. And so we want to build upon that precedent to suggest that it's actually consistent with insurable interest indemnity if you use insurance payouts not just to offset losses, but to, in fact, invest in risk mitigation that is associated with those losses. So that's example one. Example two is something that we've talked about a lot today. And I have strong views on this. Some of you have heard them. I apologize to those of you who I was too overeager in pushing this. But I want to talk about the underlying problem, in my view. In my view, the underlying problem is, of course, we have laws in every state that say insurers cannot discriminate on the basis of certain factors, even though they are predictive. And I think the first thing we have to recognize in honestly dealing with this problem is race is predictive. Gender is predictive. Sometimes we outlaw things we know are predictive. Genetics, health. These things are predictive even when we throw everything else at most problems. We still find these things predictive on most things related to insurance in terms of claims. So we have to start off with the fact that we have a legal framework that prohibits insurers from using factors that are predictive of claims, even though they are predictive of claims, because there are other harms outside of the insurance context. And I think that's most obvious with genetics, right? Why do we ban the use of genetics? Because we don't want people to fear getting genetic testing, right? Fear the insurance implications of that. So there are all sorts of reasons why we ban insurers' use of these factors, even though they predict losses. But here's the problem when we're talking about machine learning. And I banged my head against this problem. So machine learning techniques, the way that they operate is you feed them lots of data, and they find correlations between that data and the ultimate outcome of concern, i.e. claims. But the problem is our regulatory systems historically try to implement this ban by saying, well, obviously you can't use race. Oh, and you also can't use things that are an obvious proxy for race. But what are machine learning tools really capable and powerful of doing? They can find correlations between things that matter and seemingly, crazy variables that are not related to it. In fact, what I will tell you is this. If you are using a machine learning algorithm and you are training it to maximize, or minimize the number of claims, it will inevitably proxy discriminate. You give it lots of data, you might think it's neutral, you might not it's not, about race specifically, or it's not things that are obvious, you might think you've solved the problem. That is what all state insurance regulators do, in my opinion. And then they don't recognize the fact that the way machine learning techniques work is if there are factors that are predictive of risk, like race, like gender, like genetics, the way the machine learning algorithm will work is it will find correlations between any of the data that you feed it and those predictive characteristics. So I will tell you that proxy discrimination is, in my view, an inherent feature of machine learning techniques and inherently inconsistent with state law. And state regulators, in my view, do nothing about this. Okay, it's a real source of frustration for me. Now, it's not an easy problem to solve. Okay, there are great theoretical problems. I mean, that was great, beautiful theory. I didn't understand most of it. The stuff I understood was really good. Okay, and actually, there's been theoretical solutions around for some time, some of which are even reflected in the law. Right? You just figure out the omitted variable bias by including the variable of interest and then trying to control for it. There are a bunch of different papers that are out there. I was more familiar with the Sidnor paper that talks about, but here's the problem. State regulators, in my view, and maybe this is going to change, don't have the level of sophistication or resources yet to be able to police insurers' capacity to actually implement this. And there are so many complicated design choices that even if you say, well, here's what we want you to do, it's very hard to know that insurers are doing it correctly. And it's also the case that it's incredibly hard to get the data, and we heard some of this. Maybe we can use BFSG, or whatever it is, I might get my acronyms wrong, to proxy for race, except apparently there are all sorts of problems with that, and good luck trying to proxy for genetics, for health status, for ethnicity, for all the other things, sexual orientation, right? Very hard. So this is a great solution in theory, and maybe, I'd love to see it work in practice. I just don't know where they're there yet. So what actually happens in practice? There's some banning or limitations of using machine learning algorithms in some states, though my sense is that's actually stopping. I mean, from what I've heard in this conference, and it's a little bit changed over the years, it seems like machine learning techniques are becoming more and more accepted in rating and underwriting, and that wasn't true for a while. There's a bunch of ad hoc review where regulators look at external data, it's well, nothing I see that's obviously problematic, failing to recognize the way machine learning techniques work and the structure of state insurance regulation. There are ex post disparate impact audits, except we don't know what to do with them, right? We don't know. We get these results, and we're there's a disparate impact. Now what? Oh, but actually now what? And the basic problem is we don't even have a consistent theoretical lens. So I don't have a great solution here, except to say let's keep working. But I have to say here's the basics of a solution. The first thing we've got to do is we've got to define what we care about. And Malika talked about this a lot, and I have a very firm view about what proxy discrimination is. Proxy discrimination is the use of facially neutral characteristics when the predictive power of the facially neutral characteristic derives from its correlation to a legally suspect characteristic. Okay, so to put it in your terms, it's an individual notion of fairness, it's omitted variable bias. That's what it is. Let's just define it that way. And the reason we should define it that way is that's exactly what we were concerned about with redlining. That's exactly what we should be concerned about if we care about the fact, for instance, we don't want people paying higher prices if they're getting genetic tests and they have genetic ailments and then they won't get genetic tests. We care about the outcomes. And so I would say there's a good theoretical reason for doing it, there's a good practical reason for doing it, there's a good statistical reason for doing it. And then, to the extent we can, let's just collect data on this stuff. I mean, it's not exactly sensitive data to say what race you are. We ask that all the time. In fact, in the mortgage disclosure context, we ask that, we collect it, and we publicly disclose it. So the notion in insurance circles that it would be totally unfeasible to ask people about their race is preposterous. Okay? And so we can actually start collecting some of the data to better test it. We can at least start having a good, stable, analytically coherent, honest definition of what proxy discrimination is, and then we can start trying to solve these problems. Example number 3, AI in claims handling. We have heard insurers are increasingly using AI to enhance, or perhaps replace, human claims review. Now the difficulty here is No insurer will admit that they're using AI to replace human claims review, except when they're doing it to fast-track claims, okay? But we've had a lot of information that that's what's going on. So though some of you have been following the litigation regarding health insurers, you'll be aware of various public reports and phases of litigation that have alleged that for all intents and purposes, many health insurers have completely outsourced their claims determinations to AIs and to algorithms. So for instance, in very prominent litigation, it's become clear that healthcare, and I think it's United Health, are basically using their NH-Predict, it's a predictive AI model, machine learning model, to model out how much post-acute care people use, and then basically using that as de facto a coverage limit. No human intervention at all. In the PNC context, there's less information, but I think we've heard fraud is a big use of machine learning techniques, and I will say I'm increasingly hearing about PNC insurers using generative AI to summarize claims files, to potentially write claims denials. So, in some ways, this might be great, right? It may be that this is much more accurate and effective. It may be that this helps reduce that 10 to 15% claims cost and makes premiums better for all of us. But we have a real problem. And the problem is this. There's a tremendous amount of legal, socio-legal research showing that people determine the legitimacy of a system or an institution based less on the outcomes of how they're treated and much more on the process by which they're treated. Okay? People look at court systems, family systems, school systems, and they think about the legitimacy based upon whether or not they have a voice and an opportunity to be heard. There's a human decision maker who is listening to them. And so, what's pretty clear is that if we are just going to convert entirely to an AI system where they're not humans in the loop, what's going to happen is people are going to lose faith in the legitimacy systemically of the insurance industry. And that will have all sorts of knock-on effects, even if we don't think that's a harm in and of itself. People won't buy insurance. People won't trust denials of claims as being legitimate. And so it actually turns out to be a really important regulatory problem to make sure that the use of AI in claims handling is not done in a way that undermines the perceived legitimacy of the insurance industry. But our problem really is that, again, law and regulation are not where they need to be here. We have a few state laws that require a human in the loop, except they don't define that. And arguably, there's a human in the loop when the human denied every claim with 1.2 seconds of time. There's a human in the loop. 1 second. Is that a human in the loop or not? I don't know. The law's not clear. We have bad faith laws that weigh procedural factors, except the law here is incredibly unclear and opaque. And by the way, it's even more complicated than that, because bad faith laws don't even apply to employer-sponsored insurance. We can talk about that another day. And we have these vague, don't you love the summary? The summary you gave of the NISL, God, thank you for being transparent about it. This is the state of insurance regulation. Do good. Don't use AI to violate the law. That's the substance of what the NAIC has produced in 5 darn years on AI. The lack of substance in that document is startling. Okay? And so we have these vague, proclamations that AI should not be used to violate the law. Gee, thanks. What does that mean? So again, in my view, we need some specificity. We need to honestly address the problem. And I would suggest a few guideposts here. For instance, I would say that we should have a safe harbor that whenever AI is used to make claims determinations faster and to approve them, you're in a safe harbor. Okay? So if you use AI to approve claims, great. And as long as you're not slowing them down relative to where you were before AI, then you should be in a setting where we just define you as not violating unfair practices laws. We should have clearer standards for human involvement in claims determination. What does a human in the loop mean? That's a hard one. I can't give you the precise language right now, but we can have some specificity there. Okay? There's increasingly an attempt to define what meaningful human involvement work with AI is in a lot of different domains. And there's no reason why we can't do that in insurance as well if we're actually willing to look at the problem head on and deal with it with some specificity. And we should be forcing insurers to provide AI-powered tools to help people navigate claims. If an insurer has access to AI to deny my claim, maybe I should have access to an AI to help me navigate the claims process. These tools already exist, but insurers don't provide them, and many people aren't aware of them. And so these are, again, certain solutions that we can have. So the bottom line for me is this. Ultimately, law and regulation are fundamentally entangled with the way that insurance markets work and the way in which insurance economics play out. And if we don't have a good, grounded understanding of where the laws fail, where the laws succeed, what the ambiguities are, and how they vary, it can be very hard to develop policy-relevant work. And so I hope these 3 examples are helpful in seeing that. There are many others, as I was trying to tell you about, as I was dancing about when my PowerPoint wouldn't load, but I'm happy to answer any questions you may have.
So the 2 product proposals to put index insurance, to legalize index insurance. My understanding was the places that this has actually worked in the US is when the index part is a substitute for the deductible, basically. And so you don't get any false negatives. You might get false, whichever one is fine. And so you can have an arbitrarily large deductible that's an index linked.
Except you can't have an arbitrarily large deductible because, of course, there are always going to be risks with parametric, right? And so if you're putting together an actual insurance strategy, you might want to actually predominantly rely on a traditional indemnity policy because you want to make sure that if there's a really big loss, it's going to pay out. So in order to adopt that strategy of having a very large deductible in your indemnity policy, you'd have to accept a decent bit of basis risk. The other thing I would say is that strategy may work in some states. In many states, it doesn't work. And in many states, the law is simply not clear. Okay? The law is actually not clear because even if it's only filling in on the deductible, there's still the risk of a windfall, right? If you have a parametric policy and it pays out if the wind speed on your home is, 100 miles per hour, even if it's only filling in for your deductible, right? If the wind speed hits that and there's 0 loss in your property, you just won a $200 bet. In regulatory terms, that makes it a swap, at least arguably. And so the problem is, it's actually not a simple problem. There's a lot of regulatory uncertainty, and to my knowledge, that doesn't fully solve the problem. It may in some states.
I mean, you can buy it for crop insurance in the whole country. Right?
Crop insurance is different. Crop insurance is different because it's regulated by a different structure. Crop insurance is regulated federally. But the real demand for this stuff is sort of traditional property loss at the municipality level, right? And there, it's very hard to buy. In many states, it's not available at all. And so, again, part of why I think that there's a real limited penetration are the regulatory barriers. And I think crop insurance is the crop context is distinctive for a number of reasons because the legal regime is distinctive. Yeah.
But still back into that, why is that an issue that it's a swap?
Why is it a swap? Because
I understand why it's a swap. Okay, it's a swap.
Why is it a problem?
Yes, that's
okay,
amazing.
so there are several reasons. One is, if I'm trying to sell this, I don't know which regulatory regime I have to navigate. I actually have to navigate both. Okay, so I have to register it as a swap, and I have to, if I want to sell it as insurance, and also, it turns out it's not easy to just go and buy a swap. Okay? So, it's a lot easier if you have an insurance company that is selling an insurance product for it to be available broadly. It's not easy for an individual or municipality to just go and buy swaps.
But I'd say Kalshi is defining their betting as a swap.
Yeah,
and they are able to sell it quite well.
Yeah.
So why?
There are a lot of lawsuits against Kalshi right now, and the thing about Kalshi is, so I agree with you that this is sort of a very important element to this, but there are a lot of states that are pressing back on it. But particularly with Kalshi, the problem is they set the bets, right? And so you can't say, well, gee, I want to place a bet on Kalshi for $100 for this particular wind speed. Now, I guess the point you might be making is, well, gee, if we sort of categorize it as a swap, okay, maybe we'll get this lax regulatory oversight. The problem there is then you don't get any of the benefits of insurance regulation. And, for instance, solvency assurances that the insurer can pay. Okay, I mean, I'm not sure I want to go buy a swap from some rando insurer that's saying that they're going to pay out. So, having a stable, clear regulatory regime, okay, and having one where we have pretty clear understandings of how it's sold to people and it's relatively accessible and you don't have to go through the trouble of dealing with federal securities laws, those are big impediments to the development of the market as well as to the uncertainty. So I'm not saying you can't sell parametrics through swaps, but the reality is parametrics right now are minuscule in this country.
Yeah, I mean, I'm still not convinced why is that a problem. I mean, you sell a swap, you market the hell out of it. You said I am a contract. It's insurance-like. People buy it if you market it right, especially for. So I still don't see the big issue.
Well, there are a few ways of answering this question. Huh?
Are there tax issues?
There are a lot of issues. One issue is, again, there's value to state insurance regulation. There's a reason why people might want to buy a regulated insurance product where they have some assurance that the issuer can pay, and that is not provided through the swaps mechanism, the regulatory mechanism. Second, in order to access swap markets, like Kalshi is different. There are different sub-rules regarding Kalshi and the other companies than there are regarding other swaps. So you can't just go and buy a swap outside of Kalshi and whatever the other one is, right? It's actually pretty hard to go buy many types of swaps. You need to actually register as a market participant. It's just an entirely different market. So if you think that insurance regulation is valuable, which I do, if you think that regulatory uncertainty is bad, which I do, if you think that we have some evidence that this isn't working because the market's actually not developing the way that many people anticipated, then I'm not saying this is going to solve the problem, but having regulatory clarity that you can sell a parametric product as an insurance policy and that insurance agents would be licensed to sell it to you, and that insurers would be able to offer this and use their expertise to design parametric, I think would go a long way towards promoting this market. Would it solve it? I don't know. But would it help? I think so. Any other questions?
How big is the windfall problem really? Because when you think about, in a wildfire, even if my house is not burned down, if every other house in my neighborhood is burned down, if I happen to have this at my house 2 weeks ago, I don't think I'll be able to sell it. Even for wind damage, if the wind didn't damage my roof, it damaged every other roof in my neighborhood. I may have not experienced that huge loss, but it may bring awareness to potential buyers about their
I would say economically you're right, but legally it's a huge problem because legally it takes it outside of the definition of an insurance policy. Because an insurance policy is defined under state law and under federal law regarding swaps and derivatives to only be a contract that indemnifies you for loss and that doesn't include any prospect of you being made better off. That's baked into state insurance law. So I agree with you. Part of the motivation here, okay, is to take advantage of state insurance law and regulation to structure contracts consistent with those requirements in a way that meets what I think is the strong economic case for parametrics. And so that takes both an understanding of the economics and under the legal regime.
Last question.
Maybe this is a clarifying question, I guess. What makes a normal insurance contract that different from a swap if the person who evaluates damage is an unrelated third party, right?
A normal insurance policy cannot make you better off even when you've suffered a loss, with the narrow exceptions of things like ordinance or potentially replacement cost coverage. But any product that is classified as an insurance policy under state law, it is simply offsetting a loss that you have experienced, but it is not making you better off as a result of a loss, at least in theory. And so once you have a product, at least in theory, and again, this is the difficulty under current state insurance law, that has a set of scenarios in which you're made better off, all of a sudden it starts being classified as a swap, not only under state law, but actually under federal law as well. Because Dodd-Frank has a definition of swaps that itself incorporates some of these concepts. And so the legal and regulatory terrain is pretty complicated for that reason.
Okay, we can continue after the conclusion of the workshop. Please join me thanking
Okay, so I think that takes us through all the formal business. Faye, I've had a pretty good time.
Yes, absolutely.
What have you learned today?
Yeah, I mean, to be honest, I was really nervous about this workshop. I mean, lots of the presenters know how nervous I was about the attendance. And also putting a program that has so many different disciplines. Ben shared that, we worry about whether we are going just a scratch on the surface, given we are from so many different disciplines. Can we understand each other's languages? But I think at this time of the day, I feel like this is a big success because we are really having very engaging, and no matter we are from, economics or law or actual studies or statistics, I think the sessions are really engaging and we can understand most of the content. David?
Housekeeping question, can we get all the presentation slides?
I think we will ask the presenters if they agree, we'll share around. Yeah.
Sounds good.
We also have agreements from nearly everybody, I think, to post the videos.
Recordings. The recordings will be ready online. Yeah. So I just want to say thank you everyone for making this a successful event. It's an adventure. Initially, I have never seen such a multidisciplinary thing before, but thank you for coming. And also I want to announce that next year we'll have a similar thing happening in Australia, hosted by USW and joined with Wharton as well. So you are all very welcome.
We'll make it a nice time of year.
And yeah, we will make a fun time in Australia, and you got a chance to see kangaroos and the koalas. Yeah.
We don't insure against injury. Okay.
We could write parametric insurance.
So if somebody gets bitten by a snake, we can.
Forecast-based contract.
Thank you all for coming. We've left some of the remaining drinks and things outside. Feel free to stay and mingle. It's been wonderful. I think I'm going to take a leaf out of Kevin's book and say, insurance is really interesting.
Yeah. Okay.
And see you in Sydney.